The next session I am particularly really excited about it's called direct indexing. And I think it's going to be a really interesting one that's going to build on a lot of the comments that we heard yesterday on the FinTech and Wealth panel. And if you remember they were talking about this idea of direct indexing and how this tool could potentially be used for investors and advisors alike. And it's an interesting one because it's certainly a growing area within this industry, but sort of built on an old premise of the separately managed account. However, I think we're going to hear from today, the folks we'll hear from today are bringing this tool to the masses in a way, a scale and size that really unlocks it for new applications. So I'm really excited to get their thoughts today. Now, leading the conversation is Ann Elliott. Ann is a senior investment advisory consultant in Edward Jones's investment advisory training and consultation group. In this role, she's responsible for shaping the advanced training strategy to equip branch teams with a higher level of understanding of the investment advisory platforms, delivering Edward Jones's solutions-based approach. Ann began her career with Edward Jones in April of 2009, and over that time has worked as an on-call branch office administrator, a financial advisor, and most recently as a senior solutions coach. She earned her bachelor's degree in business management from the University of Missouri-Columbia, go Tigers, and a master's of business administration from Washington University's Olin School of Business, and also serves on the development committee on the board of directors of Provident Behavioral Health. Ann, thank you so much for being here with us today. I know we've been working a lot together. I'm very excited now that we're here and we actually get to hear more from this panel.
Yeah, thanks, Ed. Go Tigers and go Bears too, right? So really excited to be with you all this afternoon. As Ed shared, I'm Ann Elliott with Edward Jones and also an Olin alum. I'm honored to be with you today to moderate this discussion on direct indexing. And staying within the theme of the conference, finance, yesterday, today, and tomorrow, we'll cover the evolution of direct indexing, highlighting where we are today, and provide perspective as to how we see access and utilization evolving and adding investment value. Before we jump in though, I want to take a quick moment to introduce our panelists. So starting with Kevin Cho. Kev is a partner in McKinsey & Company's wealth and asset management practice. He serves as the global leader of Performance Lens, which is a proprietary suite of data and analytics tools developed for leading asset managers. He's a graduate of MIT and serves on the board of trustees of the Kaufman Music Center in NYC. Kev, thanks so much for joining us this afternoon.
Absolutely, pleasure to be here.
Yeah, excited to have you. Next up is another Kevin Medea. Kevin is the Chief Investment Officer of Direct Indexing at Natixis Investment Managers Solutions. He's responsible for designing the algorithms, processes, and systems used to implement direct indexing strategies. He holds the CFA designation and is a graduate of both UCal Berkeley and LA. Kevin, we're really glad to have you.
Thank you, Ann.
And last but certainly not least, we have Mr. Tom O'Shea. Tom is Ceruli's Research Director for Managed Accounts. And prior to joining Ceruli, he was most recently an investment product manager at Fidelity's Global Asset Allocation Division, where he played a leadership role in development of Fidelity's personalized portfolios and unified managed accounts for retail customers. Tom also holds the CFA designation. So Tom, really happy to have you this afternoon.
Looking forward to it, Ann.
So as you can hear, all three of our panelists have extensive experience with direct indexing, and I'm so excited to learn from them today. We were very intentional in planning our discussion to leave plenty of time for Q&A. So please write down your thoughts and questions throughout. We'd love to see them in the Q&A field in Zoom so that you have the opportunity to engage directly with this amazing lineup of panelists. So really excited to kick things off here. I thought it made sense to take a step back before we touched on direct indexing and first understand separately managed accounts, or SMAs. Given we have participants from all different practice areas and points in their career, we wanted to start with a description of separately managed accounts, or SMAs. So you can think about SMAs as a collection of individual securities. Individual stocks if it's equity oriented, or individual bonds if it's fixed income. You heard fixed income SMAs referenced in our last session too. Those collections of securities are managed by and follow a professional money manager strategy. We're all about analogies and helping our clients understand different products here at Edward Jones. So I wanted to share some with you today. You can think about this almost as the client's personal mutual fund, or a mutual fund without the wrapper, where they see the underlying securities that they hold outright versus a ticker symbol like you would in a pooled investment vehicle. It gives clients or investors the opportunity to kind of look under the hood of that investment manager strategy and see the individual stocks or bonds that they own. And that individual security ownership is really what brings some of the tax management to life that we'll touch on in direct indexing. So Kevin M., I'd like to bring you into the conversation here. Now that we have this foundation for SMAs, can you expand on direct indexing?
Sure. We think of direct indexing as sort of the third generation in index-based investment strategies. And so if you kind of rewind the clock a little and think about what maybe more people are familiar with are index mutual funds. Those started out in the 1970s, were a great way for individuals to put a relatively small amount of money into a fund and yet get very broad diversification across hundreds or even thousands of securities. So you're getting this great diversification without having to buy, 100 or 200 or 300 stocks on your own. And they were very tax efficient as well because they had relatively low turnover. So those were a great way for people to access the general equity markets. Well, in the 90s, ETFs or exchange traded funds started to come onto the market. And that was really the next iteration or generation of improvement on index-based investments. They allowed investors to buy and sell throughout the trading day because they traded on a stock exchange. But more importantly, they allowed for additional potential for tax efficiency through a creation and redemption in kind mechanism. I'm not going to go into those details, but they allowed it for an even more tax efficient way to access an index-based strategy. And now today we have direct indexing. It's really been around for a couple decades, mostly accessed through institutions, but through technology, it's accessed more and more through mass affluent and bringing the market down. But that allows you to hold an individual portfolio of stocks, as Ann mentioned, and it allows you to do some very interesting and sophisticated things with it, primarily for tax management side, but also in transitioning portfolios or customizing the portfolio as well.
Yeah, and we'll certainly talk more about those interesting things throughout the discussion, but just a couple of highlights that I hear there is this really the third phase of access to products within the industry, and that tech has enabled the access to this different type of investing to our clients. Tom, would love to hear you speak about how do you see this trending as far as asset flows over time?
Yeah, sure. So when I first became exposed to this, it was in the early 2000s when I built a network of separate account managers for high net worth RIAs at Fidelity. And this type of product was extremely popular, but the account minimums were about $250,000, $500,000, maybe even higher. And they were pretty much targeted, account averages were in the millions, and they were targeted at registered investment advisors who dealt with ultra high net worth individuals. You had family offices and multifamily offices. So you're talking about billionaires and decamillionaires that had this product, largely because you needed to have a large account. And why did you need to have a large account? Well, to mimic something like the S&P 500, you had to have at least 250 to 300 securities. And given the share price and the need to trade in round lots, that forced up the account size. But a couple of things have happened recently that have really reintroduced this to potential lower wealth tiers. And those two things are the disappearance of commissions and also fractional share trading. So let's talk about fractional share trading for a minute. What you have to do is trade a lot of stocks in order to generate the benefits, the tax benefits that will come from a direct indexing product. Well, if you can trade fractional shares, you can suddenly hold smaller lots. You don't need to have those minimum account sizes up into the $250,000, $500,000, $1 million size. So suddenly you can bring the account size that's required for this down. And also, in order to gain benefits from these types of products, you have to trade a lot. So the commissions would sometimes erode the benefits of these products unless you had large asset sizes. But if you don't have to pay any commissions, which is what you see at Fidelity and Schwab, as they've started to compete with Robinhood, you don't have that kind of friction in the account. So now you have firms like Fidelity Investments announcing that instead of having a $250,000 or $500,000 minimum, they've introduced a $5,000 minimum index SMA. And so the thinking is that this is going to move down market and start to appeal to sort of more affluent, mass affluent clienteles, which is really going to drive the growth. And the market right now for direct indexing SMA is about $460 billion. But at the pace it's been growing, it's probably going to grow at about a 12 to 13% compounded annual growth rate over the next 5 years, which is going to outpace that of ETFs, mutual funds, and other forms of SMAs. So we really think it's going to be a very popular product going forward.
That is huge growth. So 460 billion today with 13% annualized projected growth over time. And when we think about that $500,000 minimum coming down to 500,000 coming down to 5,000, wow, when you think about how that opens up access to new investors, you can certainly see how that relates to an increase in asset flows over time. Kev C, we hear about direct indexing gaining traction. And as this becomes more broadly available, who wins?
Yeah, absolutely. I'll talk about this from both the standpoints of value and also just the competitive landscape, right? And who's going to win on that front. From the standpoint of value, I think it's actually a win-win-win for manufacturers, for distributors, and for end investors. For manufacturers and distributors, it's another way to convert unmanaged assets into managed assets. If you look at the evolution of ETFs, for example, the growth of ETFs has not actually come necessarily at the expense of mutual funds, but actually in converting what was previously individually held securities, right, into managed formats. And I think that next generation SMAs and direct indexing will play a similar role in terms of converting more of those assets that are currently maybe held in individual securities into more managed formats. I think that for asset manager manufacturers, it's also just another vehicle and account that will provide an opportunity for growth, and one that maybe is at competitive fees, but is more persistent ultimately, right? So from an economic standpoint, will be attractive for those asset managers. And then competitively, I think that both wealth and asset managers can win in this landscape. Wealth managers are well positioned from the sense that the current growth of these capabilities is enabled by technology. As Kevin and Tom both mentioned, it's technology that's enabled to allow the enablement of tax optimization, of customization at scale. And some of these platforms are already lowering minimums from $250,000 to as low as $5,000 or even $10,000 per account. So really bringing this to the mass market is something that appears to be an approach that these firms are following. I think, on the other hand, asset managers are positioned more to offer features, right? So where tax management is kind of the primary value proposition today, I think that will increasingly become table stakes. And they will need to add on features on top of that, such as personalization and customization of portfolios and ways for advisors and investors to do that, which will ultimately help them in terms of getting access to some of those assets. And ultimately, I think the real kind of, opportunity way out is the opportunity to hold multiple different exposures in these kinds of accounts. So for example, right now, it's really painful and complicated to invest in private markets, right? It's a pain for end clients, it's a pain for advisors to go through all the paperwork and investing directly into private funds. If you take the comparison of fractionalization of public securities, you're seeing innovation in terms of tokenization of private market funds and private market assets. And the SMA is actually a perfect vehicle in order to actually hold and custody those assets. So I think where I'm excited is more about that next generation, which I think is going to be more personalized and potentially also provide broader access to things like the private markets in these vehicles.
So different styled asset management, providing that access to the mass affluent, I think is a really cool highlight there that you pulled out. I like the idea of tax management. And if you were here for our FinTech session yesterday, you heard Ansley say, like, I want someone that can invest on my personal beliefs, my moral beliefs, and that ESG idea that we'll talk about later in this discussion, but really resonated with me as being available through direct indexing. I also heard you talk about tax management, and this is where I want to pull Kevin in back into the conversation. Can you speak to the benefit of tax loss harvesting and direct indexing and really how that works?
Sure. Yeah. So what tax loss harvesting really is if you hold a portfolio of securities, on any given day, let's say some are up and some are down. But if you have a whole portfolio, you're getting sort of that average return of the market. Well, what loss harvesting is it takes the securities that have fallen in value, you sell those and create what's called a realized loss, and then you could reinvest those back into the portfolio into other securities. Now, if you repeat this process, let's say you did this over the course of a year, whether the market's up or down, let's say the market's up 10% that year, inevitably, again, there was some stocks in your holdings that were down. At the end of the year, you may be up around 10% if the market's up around 10%, but you'll have net realized losses realized. And so you can use those net losses to offset your capital gain distributions or capital gains from other investments, or if you don't have other capital gains that year, you can carry them forward into future years. And so the value from the loss harvesting can be very beneficial, especially if you are in higher tax brackets, right? So the higher the tax bracket you're in, the more of a benefit you're getting from deferring the taxes associated with any realized gains. So that can be very valuable.
Yeah, I like the point on the higher the tax bracket, the greater the benefit to the investor. One way that we think about this is we can all be certain of volatility in the market, right? And by tax loss harvesting, it gives clients the opportunity to take advantage of that volatility, to book those losses, to offset gains throughout the year, creating greater after-tax alpha. Now, as we were preparing for this, Kevin, you said something I thought was really interesting. You're a little skeptical about that for the $5,000 account value. So tell us more kind of what you're thinking there, because I think it's important.
Sure. Yeah, so I think it's great that we're getting access for people at smaller levels. But let's say you have a $5,000 account because you wanted to dip your toe in the water. You might not be at those highest tax brackets. Maybe you're in sort of a middle tax bracket, say a 22% kind of tax bracket. But let's say on that $5,000 investment, maybe you have $1,000 in realized losses that year. So you have maybe a $220 tax benefit, maybe, right? So is it worth the additional trouble to open another account to get a $220 tax benefit? I don't know. I think for some people it may be. I think it's more interesting that that companies are offering these because they are trying to acquire new customers. They anticipate them growing over time and perhaps being with that firm for decades. And direct indexing products and strategies tend to be very sticky, right? So once you get the assets in, people tend to keep them for a much longer time than they hold other vehicles. Again, there's a lot of tax reasons for that and customization reasons for that. But I think a lot of firms are willing to perhaps take a loss on these small $5,000 accounts with the anticipation that they're going to have these clients grow with them over time.
Yeah, I love the point there on client or relationship retention over time and perhaps even across generations. I know, Tom, you have some thoughts there as it relates to ESG specifically, if you want to hop in and share.
Yeah, sure. So we have a whole other group that looks at things like ESG, and what their research shows is that the preference for ESG definitely skews to a younger set of investors. Investors in their 20s and 30s are 2 to 3 times more likely to be interested in investing in securities that align with their values. So this is one of those classic, where's the hockey puck going, right? A lot of folks talk to advisors who have large, wealthy clients, and because wealth tends to grow with age, right? So you find that they're saying, well, my clients aren't interested in it, so I'm not. But what we see is a lot of advisors who are dealing with families and know what the younger generations are interested in are becoming a lot more educated on ESG. There's a lot of challenges with it. About 1/3 of advisors believe that it drags down performance. About 1/3 just don't want to get involved in it because it oftentimes engenders political conversations around global warming and issues like this, and they may disagree with what their client feels about that. But the reality is, when you think about ESG, if you're just confined to a mutual fund, you may have very idiosyncratic ideas of what's valuable, what's good in society than someone else. And with a separate account, you can actually target your specific ESG requirements. You don't need to customize an account for a client. And that's why it's so much better than, say, a mutual fund where you're kind of riding the bus with the values that everybody in that fund has to share. So that's why we see a lot of advisors working with younger investors who are really interested in this.
I like the point too on it's there as a tool to leverage if it's of interest of your clients, but thinking forward looking, kind of where the puck is going, to use your analogy of how does this help retain relationships over time, particularly as the primary investors continue to age, move into retirement, and the next phase.
Yes, in the next phase.
Yes. So I in meeting with you before, kind of learned a little bit about your perspective on surprise of not realizing what direct indexing is. Talk to me a little about that.
So yeah, let me give you an example. So my exposure to it was with advisors that tended to advise to the uber high net worth people. I mean, these people, when you saw their accounts come in, they were sports stars, they were celebrities, they were well-known entrepreneurs. But then there's so Morgan Stanley buys Parametric, the leading provider of this product. And we start interviewing broker advisors at the large wirehouse firms. And we start to realize that so many of these advisors don't know anything about direct indexing. You ask them, are you interested in it? They say, what is it? And these are advisors that often have a core client investable asset size of, say, $1 million to $2 million to $3 million. So this is not the uber high net worth or the high net worth. These are the borders of high net worth and affluent. And these people could benefit from direct indexing. And so you ask them, would you be interested in getting an account that would give you a passive exposure but could generate an extra 100 to 200 basis points in after-tax return for your client? Yeah, where do I find out about
Sounds
that?
Good.
So, we don't, and this gets back to some of the things that Kevin said, the next wave of this is not going to be the $5,000 account. It's going to be that market just below the high net worth clientele that can really avail themselves of the benefits of this.
I love to hear that, thinking about the future and how we continue to grow with our clients and are offering the products and services that are going to add value to them over their investment time horizon. And Kev C, I know that you've done some research in this space. What have you found on the advisor side as far as the percentage that's aware of direct indexing?
Yeah, I think completely consistent with what Tom is saying. Our most recent research, we conducted a survey of about 3,000 financial advisors as a sample, and broadly representative of the industry. Only 26% say that they're familiar or aware of what direct indexing is. On the one hand, it's not surprising given that this has been a product that's been the purview of ultra high net worth and high net worth clients. So if you're an advisor that has a more mass affluent or affluent client base, this has not been a solution that you have access to. But I think that does speak to just the tremendous amount of growth opportunity, right? To Tom's point about the growth potential of direct indexing, which is as this gets unlocked to this kind of next tier down from the high net worth to affluent, and they become more aware of the kinds of tax benefits of these kinds of strategies, which in typical years can be 50 basis points to 150 basis points. In really volatile years, it could be 500 basis points or more in terms of additional return that you're getting because of the optimization. And that's a hard value proposition to ignore, right? If that's what you have access to. I think that that awareness level needs to go way up as a result of that.
And I think that's a good transition to one of the questions that came up in our live Q&A here. So as far as knowing what direct indexing is, I think we're good. It's like, how do we access it though? And Kevin Medea, I think I'll start with you on that one. Is direct indexing something that is only available within an SMA wrapper? How can advisors access it? What about in brokerage accounts? Can you expand there?
Sure. Yeah, that's a little bit of a broad question. So for the most part, it really is a separately managed account structure where you typically hire somebody else to invest it for you because the investment process can be very complicated. It also can be very expensive. So scale does matter for a lot of people. Now, you could certainly do this on your own in your own brokerage account if you had the time, patience, and wherewithal. But the problem is then it usually leads to behavioral biases, right? So let's say you yourself, let's say you took your $10 million account, Annie, put it into a stock portfolio, you'd have to figure out what stocks to buy, what weight to buy them in, and then have the stomach to take the ones that have fallen in value, sell them off, and then immediately buy something else and stay in the market, even though it's cratering. That's very hard to do, right? Most people are going to just, their biases are going to say, I'm out, I'm going to sit on the sidelines, and then they miss the upturn in the market, which defeats the whole purpose anyways. So by hiring an investment manager to do the direct indexing for you, you're getting an extremely disciplined process that's going to keep working for you, regardless of how you feel about specific stocks, whether you saw Elon Musk tweet something or not, right? It's going to bypass all that, and it's going to work for you to your advantage in the long run.
Yeah, this idea of managed accounts can really help investors stay the course through volatility and really protect them from making decisions based on emotion that can negate performance over time. And I also heard you mention SMAs offered in managed accounts. So there's a lot of activity oftentimes happening behind the scenes here. It's a more cost-effective way for investors to access that channel to active investment management versus in a brokerage account where they would be paying by trade for the activity that's occurring within their account, which is a good transition, I think, to you, Tom. And how do we apply this to actively managed portfolios? And if you could speak to that both on the equity and the fixed income side.
Yeah, so where we're at right now in this whole phase of the product's life cycle is that many firms are now looking to apply this beyond passively invested portfolios to actively invested portfolios. And a lot of these products are really in the development stage, although some of them have launched. And essentially what they're doing is they're taking their active portfolio managers' weights and bets and using that as a reference portfolio in the same way they would use an index, and try to minimize the tracking error to that particular portfolio while at the same time offering some level of customization. And that could be taxes, that could be ESG, some of the things we talked about here. And in the fixed income area, that you can also do ESG there. There are community bonds that are considered sort of more worthy than others, communities themselves that are more worthy than others when it comes to municipal investments. And also you can generate some better after-tax returns, but it's really not at the level of an equity portfolio because you need a lot of activity to generate that volatility and capture losses. Another areas a firm I know is using this actually to fund their accounts very quickly by searching for little fragments of bond holdings out in the market so that they can quickly fund a client's account. So there's these are all mechanistic solutions to solving some market structure problems. And you're going to start to see a little more of this applied in the active area, I think in the next 12 to 18 months.
Yeah, I think that's one thing that I think is particularly interesting, especially with rates as they are today. I mean, you get access to that institutional level of purchasing power versus sourcing bonds in inventory of, whichever firm you might be associated with. Kev C, I want to kind of pull you back in here. And I think a question that we should touch on is really, to what extent can managers do this themselves? Where are third-party managers adding value?
Yeah, I think third-party managers want to do this themselves, obviously, to maintain this. And to a certain extent, I think that advisors also have a desire to continue to use third parties, right? Not just use in-house or captive asset managers or captive capabilities. So I think there always will be a need and a demand for third-party managers to provide some kind of solution, right, to financial advisors. And along these lines, I think that where asset managers can play this is one, to Tom's point, delivery of active management in these, right, expressing their points of view about the markets in these portfolios, but then offering the benefits of tax optimization alongside that. They can also offer financial advisors the ability for them to toggle portfolios, right, based on their client needs. So what are the parameters that they'll let advisors and clients ultimately influence, whether that is exposure to certain factors or sectors, or expressing certain ESG beliefs, exclusions, or positive screening. So I think those are all things that that asset managers can continue to offer as a feature set on top of these current portfolios. But at the end of the day, that's still an area that I think these firms are building capabilities in. I think 95% of the assets in direct indexing is still really kind of focused on this tax optimization play. And then that remaining 5% is more on this personalization play. Though, to be fair, that personalization play is extremely fast growing. So I think a lot of managers are making the bet that investors want this.
Yeah, and that aligns with the conversations that I'm certainly having in my role with advisors is the tax management is the biggest interest today. But what I hear from you, Tom and Kev, is this interest on ESG is only going to continue to grow over time. So it's important that advisors have that underlying understanding of how does this offer value today and how do we continue to think about this to grow our practice and to retain client relationships over time. Kevin M., any thoughts you want to hop in with here?
Yeah, sure. I'll, make some comments on ESG or customization in general, where, again, like you mentioned, the advisor's own personal values or biases may not align with their clients, and even husband and wives can't agree on a lot of things, right? So what direct indexing really allows you to do is to customize at that individual account level. So let's say, you don't want sort of tobacco or alcohol gambling stocks in your portfolio, but maybe your spouse is actually okay with those and actually wants those because they like going to the casinos every weekend. You can create two separate portfolios, one that excludes them, one that includes them, or you can have customizations really at a very fine granular level down to the individual stocks. And so direct indexing and SMAs in general can allow for that. But if you do that with a traditional active manager and the active manager likes that stock, you're basically, it's just, you're saying, no, I don't want the stock that the active manager wants. It's counterproductive. But within a direct index, it's more flexible because you're creating your own individual index portfolio that only includes what you really want in there. So I think that can be very valuable to people who have very strong views. Also, that's what we see sometimes is that people are changing their customization over time, right? So at some points they don't want certain stocks or companies, and then later on they want to add additional screens in or relax others, or they may have, say, other portfolios, a tech portfolio on the side, so they want to carve out that from a direct index more for risk purposes as well. So there could be a variety of reasons why they do this, but it allows really that granular control.
Yeah, a really important point too on getting to know your clients or investors at the client versus relationship level. So there may be differing views between even the same family that you're working and planning with. So appreciate you pulling that out. And frankly, this idea, the reason they're looking for that additional customization, it frankly doesn't matter at the end of the day. It's just being able to provide that access and that ability to them should they choose to leverage it. And I know that we've talked about tax alpha, the tax efficiency provided by direct indexing. How does that impact clients who might be transitioning in an existing book of business from either outside the firm or maybe going brokerage to managed?
Yeah, so that we see that quite often. I'd say maybe about half of our accounts come in with stock funded portfolios from either another source. Maybe their fathers have managed it for them for 20 years. They don't know what to do with it. Sometimes it's single stocks. Sometimes it's hundreds of stocks. It can vary. And a lot of times advisors are just simply moving around from firm to firm. And when they do that, a lot of times they're at very big risk of losing their clients. In order to take their clients with them, oftentimes the only option for clients is to liquidate their portfolios and start fresh, which can be a huge, huge tax burden. And while your client might like you, they don't like paying taxes, and that may exceed their fondness of you. So using direct indexing for transitioning purposes is very common, where you could bring in those existing stocks into that direct index portfolio and then manage around it for tax reasons. You can constrain the tax gains, for example, and say, look, I'm great, I'm fine bringing in all these stocks. I know it's misweighted relative to the benchmark, but I don't want to realize any net capital gains. Just rebound, or just transition over time. If you're able to offset that with losses, like in today's environment, for example, you might be able to transition them more efficiently and effectively with no net gains if you just simply managed it properly given the market conditions or over time. So it gives a lot of flexibility for those.
Yeah, interesting point too on the portability of client relationships then as you're leveraging these strategies to make it easier for them if they choose to continue to stay with their advisor as they move between firms. They can do so without a negative impact or as much of a negative impact from the tax perspective moving between firms and different managed programs. Tom, any thoughts here on the tax perspective?
Well, yeah, it's funny. Since we talked, I was reviewing some of the interviews we did, and I stumbled upon, I forgot this interview, with an advisor who totally believed in active management. We talked about it. So but he did use, was a big user of indexing, direct indexing, just to transition client accounts. And once he got him over into his active strategies, that was done. But he saw a real value just in the transitioning part. And the tax thing, I know we talked about this earlier, this past year, I have the most boring portfolio in the world. It's a collection of 60-40 low-cost mutual funds. But I just, and so I never sell them, right? It's just, I hold them, buy and hold them. I just get hit with an enormous capital gains tax from the mutual funds selling off all these securities. And once, I remember when I first got started investing in mutual funds, I actually invested in a fund. And 2 weeks later, I get hit with the capital gains tax for capital gains that I really didn't benefit from. So this talks about, when you're riding that bus with everybody else, things happen to you from a tax standpoint that are really not in your benefit, but more in sort of the portfolio manager's benefit and wanting to reallocate the portfolio.
So great point there on capital gains. It's been a particularly rough year for those, right? And that's one thing that we talk about a lot is this idea of individual ownership. So you have your own cost basis, not that of a pooled vehicle. So you're not paying taxes of an investment held over 20 plus years or whatever that timeline is. If you just purchased in 2 weeks ago in an SMA, 2 weeks is that client's holding period. So great point there. And when we think about who benefits from this overall, we've talked about tax management, wealth managers. Tom, where would you expand?
Well, I guess this goes back to something Kevin C was talking about, which is who's going to really be the one who ends up winning here? Will it be a third-party asset manager? Will it be the brokerage firm that can do this themselves in many cases? Or when the two of them are collaborating in the same account, as you find in, say, unified managed account, where the brokerage firm's acting in a tax overlay capacity, but now you have this third-party asset manager doing tax overlay. There still needs to be a lot worked out as to how those things come together without colliding into each other. So most of this is done in a standalone basis. Not all of it, but it's when a third-party manager is involved, it's usually done in a standalone basis outside of a unified account. So there's a lot more work that needs to happen to kind of bring it into that type of ecosystem.
Well, with 19% of advisors aware of what direct indexing is today, what's our barrier, our limiting factor in awareness? And Kev, I'd like to get your thoughts here as the person that ran that research.
Yeah, I mean, a lot of limiting factor is just that, again, historically, the value proposition has been accessible to investors below a certain threshold. Again, I think we're seeing that change very rapidly. I think that a lot of asset managers, for example, haven't had these capabilities before. You've seen a large number of transactions happen recently where asset managers are now acquiring into, if not building, these capabilities. So I think that a lot of that foundational work was not there before, that now firms are more competitive in, where historically maybe just Parametric was really the 800-pound gorilla that was going after this. Now you have several 800-pound gorillas going after this very actively. So I think that will really accelerate the uptake and awareness levels for these strategies. I think another positive benefit of this is to some extent almost re-empowering the power of the shareholder, right? Over the last 20, 30 years with passive investing, you've basically seen proxy votes and that power getting concentrated amongst 3-4 very large passive players. In a lot of ways, I think that there's positive benefits to seeing that come back, right, to individual shareholders. That's another more market-based benefit that I would just kind of throw out there in thinking about this.
I know, Kevin, Medea, you made a point at the beginning, this really being the third phase of access to products. I hear that in Kev's remarks as well. As we think about just broadening access, awareness will continue to grow. Tom, any thoughts that you'd want to hop in with?
Yeah, just that I think these products really grew fast in the RIA channel, and those advisors tend to do a lot more financial planning. And so in the brokerage channel, you had firms that were really just picking stuff where advisors thought their value proposition was to choose securities, to pick a stock that will beat the market, right? And more and more, that value proposition moved into asset allocation. And even that with robos has become commoditized. But really, it's moving into financial planning. What are our clients' goals? And this is a way for you to offer exposure, but it's to passive, but still add some value and thereby get paid for it and dovetail that into an overall financial plan for a client.
Okay, excellent point on the overall financial plan, right? We've talked a lot about tax alpha, but what about the FA alpha? investors no longer need a financial advisor to access the markets. I mean, they can do that on their own through a no-cost option. So it's increasingly important that advisors are really stepping up to ensure that they're providing, the holistic approach to goals and planning, not just talking about the products. We had a fintech panel again yesterday, and I pulled this quote out of it because I thought it was so interesting. So you've got the fintech panel saying, and this is from Adam Holt, which I loved, we won't be relevant if we're only talking about product. Now, we spent a good part of the last hour talking about product and the value that it adds, but the most important point to really pull through here is that we have to understand that the value delivered needs to come from the advisor and the coaching and the goals and the planning space, and how we can help investors achieve what's most important to them, whatever it might be. And the tax efficiency, the personalization through direct indexing only helps support what is of paramount importance to the client, and that's them and their financial futures. So I think looking at time, that's probably a good note for us to end our discussion on. I would love to hear from our participants. What questions do you have for Kev, Kevin, or Tom? We'll give folks a second to hop into the chat there. I mean, don't be shy. I was really excited when I learned I get to work with these panelists today. I mean, these truly are leaders in the space. So what questions do you have while we're here? Here we got one popped in. What firm do you admire in this space besides your own? Well, that's a nice question. Kevin, I think we'll start with you. We love Natixis at Jones. Would love to hear more. Who else is out there?
Thank you. Yeah, what's interesting is there's a lot of competitors coming online right now, and if you follow the news on direct indexing, like myself, a direct indexing nerd, companies are either building or buying this right now because they realize it's just a huge opportunity. So Tom already mentioned parametrics, so I'll give them their due just because they really were a pioneer in this space. And they've really established a great reputation for building this out with a lot of firms. But again, a lot of competition is coming online with different bells and whistles. We think we're very differentiated from our competitors as well. I certainly have to give due respect to the Vanguard, Fidelity, and Schwab's of the world that are really approaching this from bottom up as opposed to top down. And they've done a lot of interesting things where they've tried to bring investing capabilities down to really just the absolute masses, down to the absolute bare bones. And so they've been great with really helping investors to understand capabilities that maybe they don't get as much advantage from as a higher net worth client, but it still gives them access and helps them grow and learn. So I think as both Kev and Tom alluded to, there's just a huge amount of growth that's going to occur in the marketplace, a huge amount of education that's needed. And so as you also hear people talk more about taxes, the Tax Cuts and Jobs Act is going to sunset in a few years. Tax rates will go up every April. Tom's reminded about how he has to pay taxes. Tom's point was also very interesting to me because this is a year where we might end the year down, but Tom is still going to get a cap gain distribution and still owe taxes on things he's losing money on, right? Mm-hmm. That just adds insult to injury. So again, there's just a lot of growth in the marketplace, a lot of good firms out there. They're all slightly different than each other. So if you are going to, look into this area, you might want to look at a few and understand their differences.
Yeah, and if you're wanting to learn more, it's like pull up the fact sheets of different strategies that are out there. Do some research. There's so much that's publicly available. And our own Kevin Medea has a great series out on Natixis's public website on defining direct indexing, tax loss harvesting. So really a lot of really cool resources to help you learn more. And as someone who's in the space of educating and consulting with financial advisors, I'm certainly excited about growth. And I like to hear you say, Kevin, you're a direct indexing nerd. I would count myself in that space too, and hope after today, all of our participants are as well. So another question that comes up here is there a point where tax loss harvesting, which we've talked a lot about, comes at the cost of performance? How do we balance those?
Kevin, why don't you talk about like tracking error and things like that, and what you guys do algorithmically? I don't know if we got into that.
Sure. Yeah. So yes, I would say that customization can be very impactful on the tracking error. So people are going to have to start making choices, right? We can't have, huge returns, no taxes ever, and zero tracking error. It's just that those compete with each other. So in order to have low tracking error to any index, you have to have turnover. You have to sell things that the index is removing. You have to buy things that the index is adding. You have to rebalance the portfolio. That is inevitably going to have some cap gain impact to it. When you're loss harvesting, you're going to have to sell things that the index would otherwise want, right? So let's say the largest names are down in the index. If you sell them off, you're going to have tracking error, but you're going to have a tax benefit. So it's very difficult to optimize all of these things perfectly. There's always a trade-off. We also get client accounts where they have very concentrated portfolios. So maybe they have only one stock. We have some accounts where you might have, say, 80% in a single stock, but they say, I don't want to realize any gains. Well, this thing might have a zero basis at $1 million value. If we don't want us to realize any gains and we can't sell it, you're going to have tracking error versus the index. So it's not an easy thing to answer for anyone. It's definitely a trade-off. We have systems that we can run that will allow people to see what those trade-offs are. We think that's very valuable. So they can say, look, if I do nothing, here's what my predicted tracking error looks like. If I rebalance completely, my predicted tracking error may get very low, but at what tax cost, right? And am I willing to do something in between? We think those types of tools are really helpful because it lets the advisor and the individual say, okay, here's where I'm comfortable with given my tax considerations, given my comfort level with single stock risk, here's what we're comfortable doing, and then we'll revisit this over time.
I like the point to the what do we do in the in-between or over time. So there are great strategies in there to help mitigate or reduce taxes realized. And one of them that I don't think we talk enough about is getting to know your clients and what assets are they not currently holding with your firm. So what cash is available at the bank to bring into this strategy so that we can start with the most tax efficient transition into the program and then reduce over concentration through volatility or over multiple tax years. Kev Cho, I'd love to hear from you. You know, you've done a lot of research in this space. Was there anything that surprised you?
Yeah, maybe one piece that was a broader point on ESG, which is in the research that we've done, obviously ESG is this kind of massive topic that everyone's talking about. When you ask end investors and advisors, you know, do they actually care? Only a quarter or so say that they really care and that they're going to make significant allocations into ESG related strategies. And for me, like that quarter is probably that cohort that will say, look, we're willing to make certain performance return trade-offs if it does generate outcomes, right, that are positive for society. But there's a real gap in reporting and knowledge and proof points, right, about also these strategies achieving that other outcome. So what we hear is even those who are more skeptical, they want more facts, right, to show that ESG does, in fact, actually improve performance in certain cases. And I think that you can make that case in certain strategies. I think in the fixed income world, it's actually much more difficult because of how ESG ratings work and how they're implemented. You almost, by definition, have a yield hit, right, in optimizing for ESG. So I think there's a lot of opportunity for the industry to one, just be more rigorous in terms of some of those proof points in supporting advisors as well, right, in terms of some of that data and information, and really looking at what is the real investor demand about how they want to express their points of view in portfolios. Is it ESG? Is that more of a generational push that you're trying to anticipate? And certainly there's more interest than 25% amongst younger investors. But yeah, are the largest proportion of investors now, do they care more about thematics or sector tilts or things of that nature? So I think there is a broader set of things that advisors need to optimize against, not just ESG.
Yeah, good point there. So if a quarter cares, there's 75% that are prioritizing something else over ESG. Of that quarter, though, I wonder, do you see that population looking to forgo performance in favor of ESG, or is it just something that's a consideration?
It's a consideration. I think that they're more likely to be willing to forego some underperformance, right? Again, if you can prove that you're achieving real world outcomes that are fundamentally superior on either climate or societal considerations. But as you're saying, inherent in almost the way that respondents are answering is there's almost an assumption these days that ESG is something that requires a performance hit, which I actually don't think is necessarily true. So that's for me more of the opportunity for manufacturers and distributors to speak a bit more about what is the actual impact that these strategies have, and should investors expect a performance hit or not.
And Tom, what about you? Anything that's really stood out in the research that you're leading for Cerulli?
Well, I think it's the growing awareness. So we did some interviews last year, and it was the lack of awareness. But the recent interviews we've been doing, there's a real interest in it, and I think that has to do with some of the acquisitions that you've seen happen in the industry. So if you have a big firm like Morgan Stanley buying Parametric, and they have a huge wholesaling team internally, as well as the Parametric team. They are now, and they're a huge marketing engine. The same with BlackRock buying Imperio. These firms are going to start hammering away at advisors and educating them on this particular product. And so we're starting to see that in the interviews we've been doing recently, as people are becoming aware of the product. So, and that's part of the reason we've sort of factored in that growth, that 12 to 13%. A lot of it is based on the rolling average over the past 3 years, but then a lot of it is based on our assumptions about how much these marketing engines are going to drive awareness of this product.
Yeah, as more people are learning about it, they're figuring out how to integrate it into client portfolios. As we think about this growth of direct indexing in the space, is there any sort of concern about regulatory or tax policy changes impacting direct indexing?
Well,
Kevin,
I'm sure, but Kevin, I'll let Kevin answer that. But I will say that when we talk to the asset managers like Kevin's firm, they have people who just spend all day studying this stuff to make sure they're aware of, what's happening and what's going to come down the line.
Yeah, I mean, we're certainly impacted by tax law and tax law changes. If rates go up or down, that's a kind of a normal thing to happen every few years. What can get a little trickier is perhaps they change the rules on mark to market, or where you have to essentially realize all your unrealized gains every year just for tax purposes. That could be very impactful. Or if they change the way the loss harvesting rules, or let's say, and here's another good one. If they remove a step up in basis, for example, that's hugely impactful. Yeah. Now, that doesn't mean people shouldn't still do this. There's still a tremendous amount of value during your lifetime. Your heirs might not make out as well, but you probably don't care as much about them as yourself. So again, these things are impactful, and we adjust as we go, but it doesn't eliminate the value from tax loss harvesting.
And I like the idea of adjusting as we go there. I would offer, if anyone else wants to hop in the Q&A, please do. So there's a Q&A button in Zoom that'll let you send a question in to us, and we're reading those live. We've got one here. We've talked a lot about taxes and performance. What about risk management, reducing volatility, or providing clients with less dispersion of returns? Who wants to start on that?
So that's one of the factors that direct indexers do offer, sort of a low vol portfolio. You can just exposure to the S&P 500, but you can lower your volatility, and that is very popular. Certainly not as popular as taxes, but it is a popular approach.
All right. Well, I think we can go ahead and end it there. Really appreciate your time, Kev Cho, Kevin Medea, and Tom O'Shea. I think this has been a great discussion. Super appreciative you taking time away from your day to join us today at WashU Olin's Wealth and Asset Management Conference. I know I've certainly learned a lot, and know our participants have as well. So big thanks, and hope you all enjoy the rest of your day.